Welcome to the Deep Dive. Today our mission is to cut right through the corporate jargon.
We're turning a really complicated financial move into, hopefully, some clear business insight.
Exactly. We're taking a hard look at the recent announcement from Tilray Brands, Inc., that's ticker TLRY.
And specifically, their decision to execute a reverse stock split.
Yeah, and this is a move that, a lot of people see and they immediately think trouble.
Right. It's often associated with struggling companies, but when a massive global player like Tilray does it, you have to look a lot deeper.
That context is so important.
It is. I mean, Tilray isn't just a cannabis company anymore. They're a global lifestyle and consumer packaged goods company.
40 brands, 20 countries.
Yeah, across cannabis, beverage, wellness. These are highly regulated sectors. This is a serious operation.
Right, so this isn't some small company scrambling for survival. This is a multinational CPG firm announcing a definitive 1-for-10 reverse stock split.
So our goal for you, whether you hold shares or just track the sector, is pretty clear.
We want you to understand the mechanics, the why behind it, and what it really means for Tilray's massive global ambitions.
This is your shortcut to being well-informed on a really critical moment for the company.
Okay, so let's start with the fundamentals, the math.
The 1-for-10 ratio.
Right. For an investor, how does this actually transform their holdings, and why is this change so big?
Well, the mechanism itself is pretty straightforward. You have 10 old shares and you exchange them for one new share.
Okay,
But what's absolutely critical to grasp here is the preservation of value.
so you're not losing money.
Not in theory. When the share count drops by a factor of 10, the share price should mathematically increase by a factor of 10.
And the total value in your portfolio stays the same.
Exactly. Your total market cap, your equity value, it's all the same.
Yeah.
It's really just a cosmetic adjustment. It's not like they're raising money here.
Right, not a true value creator, more of a structural tool. But the scale of this is what's so dramatic.
It is.
Before this, Tilray had what? About 1.16 billion shares outstanding.
An enormous float. I mean, 1.16 billion shares. That often creates a perception of high volatility, maybe a low barrier to entry. So this 1-for-10 conversion just instantly reduces that number from 1.16 billion down to around 116 million.
So you're eliminating over 1 billion shares from circulation.
Gone. And that massive float is a huge talking point in the market. A high share count like that can sometimes make a stock susceptible to, huge retail turnover and price swings.
It can almost hide the company's real value.
It absolutely can. A smaller number of higher price shares, well, that often appeals to a completely different class of investor.
We'll get to that. But first, the implementation. This wasn't a snap decision, right?
Not at all. The stockholders actually approved the authorization for this way back in June of 2025.
And they gave the board some flexibility, if I remember correctly.
That is a crucial detail. The approval wasn't for a fixed number. They let the board implement a split somewhere in a range between 1-for-10 and 1-for-20.
And they chose the minimum.
They chose 1-for-10, the least aggressive option available. That suggests they did the math and figured this was the exact adjustment they needed to hit their goals.
Without maybe making the stock price look artificially high.
Precisely. If they'd gone 1-for-20, the price would have doubled again, and that could look a little strange. This signals a very targeted approach.
Okay, so let's get into the detail that always trips people up.
Fractional shares.
Yes. What happens if you owned, say, 105 shares? You now own 10, but what about those other 5?
Right, they don't give you half a share certificate.
No.
No. Tilray confirmed that, in line with standard practice, fractional shares will not be issued. Instead, you get cash.
Cash in lieu.
Exactly. They basically liquidate that small fraction of equity for you based on the closing price right before the split.
And for anyone listening who's sophisticated about this stuff, that cash payment, even if it's small, is a taxable event, right?
Absolutely.
Yeah.
That is a realized gain or loss. It's something you have to factor in. And it's a bit of complexity hidden behind what seems like a seamless process.
Okay, let's move on to the timeline and the logistics. The announcement came on November 26, 2025. The timeline seems very quick.
The clock is moving fast. The official change, the effective date, is 4:01 p.m. Eastern on December 1st.
That's the internal switch.
Right. But the market impact, the day that matters for trading, is the next morning, December 2, 2025.
That's the crucial date. That's when the shares start trading on a split-adjusted basis.
Yep, under the same ticker, TLRY, on both NASDAQ and the TSX in Toronto.
And keeping the ticker is pretty important for continuity.
It is for investor recognition and, for the indexes. But behind the scenes, this is a whole administrative reset. The post-split shares get a new CUSIP number.
For those tracking it, that's 88688T209.
And you have Pacific Stock Transfer acting as the paying agent, making sure everything is processed correctly, including those fractional share payments.
Now, let's talk to the individual investor who might be thinking they need to call their broker right now.
The good news is you probably don't. If you hold your shares through a broker, a bank, a trust, this whole process is almost entirely automated.
So you just wake up and your account looks different.
Your positions will be adjusted overnight. Your broker handles the administrative load. Generally, no action is required from you.
And crucially, this doesn't actually change your standing with the company.
No, that's the core principle here. The source material confirms it. The split is not expected to affect any stockholder's ownership percentage.
So if you owned 1/1,000,000th of the company before,
You still own 1/1,000,000th of the company after. The only tiny, tiny deviation comes from that fractional share payout, which turns a sliver of your equity into cash.
so the pie hasn't changed size, we've just sliced the pieces differently. Which brings us to the biggest question.
What?
Why go through all this hassle if the value doesn't change? What's the strategy here?
This is where we move from the math to the motivation. And while, like we said, reverse splits can look negative,
Like a company is just trying to stay listed on the NASDAQ.
exactly, trying to get back over that $1 minimum, but Tilray's announcement gives a much broader set of reasons. They cite 3 core objectives.
Okay, let's start with the first one, which is aimed right at their competitors.
That would be alignment with peers. Tilray operates as a global CPG company. That float of 1.16 billion shares was just out of sync.
It was huge.
By cutting that down to 116 million, they bring their capital structure more in line with other established large-cap companies. They want to be viewed as a stable operation, not a high-float, high-risk entity.
And that ties directly into the second, and I would argue, most important goal.
Institutional attraction. This is the big one.
The big money.
This is the major financial lever. So many institutional investors, mutual funds, pension funds, they have rules or charters that stop them from investing in low-priced stocks.
Stocks under $5 or even $10 a share.
Right. So Tilray's reverse split is designed to instantly lift the share price, making the stock eligible for these huge pools of institutional capital that were previously off limits.
And that's a point the average retail investor might not think about. You change the price, you literally change your potential investor base.
You do, and institutional money is often seen as sticky money. It's more stable compared to the day-to-day volatility of retail trading.
And it's not just about price, right? It's about indexes.
Yes. Some of the big index compilers and ETF providers, they have criteria about float size and trading volume too. A lower, more consolidated float might satisfy different liquidity rules, making the stock more suitable for inclusion in key indexes.
Which then triggers passive buying from funds that have to track those indexes.
It's all about strategically positioning yourself for that index inclusion.
Okay, let's play devil's advocate for a second. A lot of reverse splits, they don't end well. The stock just drifts back down.
And that skepticism is valid, and you can be sure the market is watching very closely. The difference here, I think, is that Tilray is explicitly connecting this structural change to future profitable growth.
They're not just trying to stay listed.
No, they're framing this as removing a technical barrier to get the capital they need for future global expansion. It's a very different story.
And that brings us to the third objective, which was the one that really surprised me, the operational detail.
The cost savings. This is the little nugget that really separates this announcement from a standard one.
They actually put a number on it.
They did. Tilray said that reducing the sheer volume of shares directly reduces costs tied to the annual meeting of stockholders.
And the number was up to $1 million.
Up to $1 million in cost savings on an annual run rate basis.
That is not pocket change. It just shows you the massive kind of invisible administrative weight that comes with managing over 1 billion shares.
Just think about it. Mailing materials, proxy processing, shareholder communication. When your shareholder base is that huge, the costs just explode.
So by consolidating that base by a factor of 10, they're not just changing a number, they're streamlining their entire compliance and saving money that goes straight to the bottom line.
It's a powerful statement that they're focused on efficiency in every single part of the business.
So we have the mechanics, we have the immediate goals. Now let's connect this to Tilray's future. The forward-looking statements in the announcement make it pretty clear this is a foundational move.
It's an enabling mechanism. Management is using this cleaner capital structure to support their big goals. long-term profitability, achieving operational scale, revenue growth.
And hitting their fiscal 2026 financial guidance?
Right, including their expected adjusted EBITDA. Without a more institutionally friendly stock, getting the funding for all that is just significantly harder.
So how does a higher stock price, specifically, make their U.S. expansion plans more viable?
This is a key insight. Tilray, like a lot of Canadian cannabis companies, is really restricted in the U.S. because of federal prohibition.
For now.
For now,
Yeah.
when U.S. federal legalization or even just rescheduling happens, Tilray will need a massive amount of capital to jump in for acquisitions, for expansion.
And if they need to raise, say, $500 million.
It is far better to do that when your stock is at, let's say, $50 post-split than when it's at $5 pre-split. You have to issue far fewer shares.
So any future equity raise is way less dilutive to the people who already own the stock.
Precisely. It maximizes the value of any future offerings. They're preparing the balance sheet for the moment the U.S. market finally opens up.
The sources also mentioned some internal levers, specifically leveraging artificial intelligence strategies.
And that, to me, signals an integrated focus on efficiency. The $1 million savings from the split shows they're thinking about financial efficiency.
And the AI shows they're thinking about operational efficiency.
Exactly. Supply chain, customer engagement.
Yeah.
They want to be a lean, high-tech CPG company that just happens to be in the cannabis space.
And this all just reinforces that bigger mission, doesn't it? To be a premium lifestyle company, not just a commodity producer.
It does. The reverse split is like the financial scaffolding that supports that global ambition. They're clearing the decks of a massive retail float and preparing the stock to attract the kind of long-term institutional money they need to elevate their brands and capitalize on what's coming.
This has been a really deep dive into the calculus behind this move.
Yeah.
Let's just quickly summarize the key knowledge you can carry forward on this.
Okay. You understand the immediate mechanics. 1.16 billion shares become 116 million. It starts trading on December 2nd.
And you know that mathematically, your ownership percentage stays the same.
And you know the why. Aligning with peers, attracting those big institutional investors.
And capturing up to $1 million a year in real, tangible cost savings.
And finally, you grasp the future implications. This preps them for less dilutive capital raises for U.S. expansion and supports all their long-term goals.
So here's the final provocative thought for you to consider as you watch how the market reacts. Given all the volatility and regulatory uncertainty in the cannabis sector, does a reverse stock split, a move that is typically just financial engineering, does it truly change the market's fundamental perception of a company's stability and maturity?
Or is it just a necessary step that has to be followed by real, sustained operational success?
That's the knowledge you can carry forward when you see other companies in high-growth industries make a similar move.
An excellent point. That shift in perception is maybe the most valuable, intangible asset they're trying to create here.
Thank you for joining us on this deep dive. We encourage you to explore which major indices Tilray might now be eligible for. We'll see you next time.